Massive bottom line beat, but a top line miss. I mean, that is the headline for Keyera Corp's Q2 2026 earnings.
Yeah, it's a pretty wild split when you actually look at it.
Right. So we are looking at an adjusted basic earnings per share of $1.19 Canadian. And that is up against a consensus estimate of just 33 cents.
Wow.
Yeah. We were talking about a staggering 259% beat on the bottom line. But the revenue, it came in noticeably light.
Really light. I mean, depending on whether you're tracking GAAP or, the physical sales, revenue landed roughly between 1.99 billion and 2.4 billion Canadian dollars.
Right, which completely missed the 2.17 billion analyst forecast.
Yeah.
So today in this deep dive, we're pulling directly from Keyera's Q2 earnings call, management guidance, and institutional analyst notes.
Exactly.
Because we have a mission for you today, which is to figure out, is this energy giant's low-volume, high-margin flex actually sustainable?
That's the big question. Because management is clearly projecting confidence, right?
Yeah.
They reaffirmed their 2026 guidance, which includes a marketing realized margin projected between 360 million and 390 million Canadian dollars.
Yeah.
And they are standing by their target of a 16 to 18% compound annual growth rate for fee-based adjusted EBITDA per share from 2025 through 2027.
But the market reaction to all this was just pure whiplash.
Oh, absolutely. I mean, in the regular session on August 6th, the stock popped 2.78% to close at $58.79.
Right. The headline algorithms and the retail buyers, they saw that massive EPS beat and just jumped right in.
Yeah, but then institutional reality set in. Literally the very next day, August 7th, the stock fully reversed, sliding 2.86% to close at $57.11.
I look at this earnings report and it really feels like a retailer seeing a massive drop in foot traffic in their stores. Like, they completely missed their overall sales volume targets.
Right.
But somehow, they still walk away reporting record profits because, the handful of items they did sell were these insanely high-margin luxury goods.
Yeah, it looks great on paper for a single quarter.
Exactly. But if you're managing your own portfolio, it forces you to ask, is that type of, low-volume, high-margin earnings beat actually sustainable for a capital-intensive energy infrastructure company?
Right. And to figure out if that margin growth is a permanent structural advantage or just some temporary accounting illusion, you really have to look under the hood at the physical movement of the commodities.
Okay, so let's break down the segment performance.
Yeah, so the core fee-based segments, that's gathering and processing, along with liquids infrastructure, they posted record realized margins. But, you have to separate organic growth from what was simply purchased.
Oh, right, because this wasn't just existing pipes suddenly pumping more volume.
No, not at all. This was driven by two massive acquisitions. Keyera absorbed the Plains Canadian NGL business, and crucially, they bought the remaining 50% of the KAPS pipeline from Stone Peak for 1.215 billion Canadian dollars.
Wow.
Yeah, that gives Keyera 100% ownership of that specific asset.
Okay, I want to dig into that KAPS pipeline acquisition because throwing $1.2 billion at a single asset, I mean, that is a massive capital allocation decision.
Oh, yeah, it's huge.
So help me understand the mechanics here. Why is full ownership of KAPS so critical to hitting those record margins in the liquids infrastructure segment?
Well, it really comes down to geography and geology. The KAPS pipeline is this critical piece of infrastructure connecting the Montney and Duvernay regions directly to the liquid hub in Fort Saskatchewan.
Okay.
And those two regions are incredibly prolific, unconventional shale plays. The natural gas coming out of those basins is what the industry calls wet gas.
Wet gas.
Yeah, it is heavily loaded with natural gas liquids or NGLs, things like ethane, propane, and butane. So producers need a way to transport those liquids away from the wellhead to a fractionation facility where they can be separated and actually sold to downstream markets.
So KAPS basically acts as the primary toll road for these producers.
It is the ultimate toll road. I mean, midstream energy is a volume business, and KAPS is highly utilized because producers in the Montney and Duvernay, they just have very few alternatives to get their product to market.
Right.
When Keyera owned just 50% of KAPS, they split the toll revenue. But by consolidating 100% ownership, every single dollar of that fee-based margin now flows directly onto Keyera's income statement.
Oh, wow.
Yeah, the fee-based segment realized margin grew 37% year over year, and that pipeline consolidation is the engine behind it.
Okay, so the fee-based side of the house is humming along largely because they buy out their partner on a major toll road. But that brings us back to the top-line revenue miss.
Right.
If KAPS is pumping out record margins, where is the drag coming from?
The drag was entirely concentrated in the marketing segment, which actually saw margins decline year over year.
Oh, really?
Yeah, the core culprit was a 5-month outage at the Alberta Envirofuels facility, commonly referred to as AEF.
Okay, let's unpack that AEF outage because 5 months, that is a massive amount of downtime for an industrial
It's a
facility.
huge deal.
What exactly is AEF producing that caused such a noticeable dent in the top-line revenue?
So AEF produces isooctane. For those modeling the midstream sector, isooctane is a high-value, high-margin specialty product.
Okay.
It has a very high octane rating and low vapor pressure, making it a highly desirable blending component for premium motor gasoline,
Oh, I see.
especially in markets with, strict environmental regulations regarding emissions. Keyera's marketing segment doesn't just move gas from point A to point B.
Right.
They actually rely on selling these upgraded premium products to boost their overall revenue. So when AEF goes offline for 5 months, you completely choke off those isooctane sales.
Okay, well, that perfectly explains my luxury retailer analogy earlier.
Yeah, exactly.
The marketing segment, like the foot traffic, it stalled out because their premium product factory was literally shuttered.
Yeah.
Meanwhile, the KAPS pipeline and the Plains acquisition, they masked that revenue drop by providing a massive surge in high-margin, fee-based tolls.
They did, but there is a second layer to those record margins that we really have to clarify, because it is the primary reason the EPS printed at $1.19.
Okay, what is it?
The operating margin was aggressively boosted by a $255 million unrealized non-cash gain tied to risk management contracts.
Wait, hold on. This is where I have to heavily push back on management's whole record margins narrative.
I figured you would.
Yeah, I mean, are you telling me that a huge chunk of this massive bottom-line beat is just an accounting quirk?
Pretty much, yeah.
Booking a $255 million non-cash gain, that feels a lot like looking at your net worth on a spreadsheet after the, I don't know, illiquid land you own goes up in value.
Right.
You feel rich, your balance sheet says you're rich, but you can't actually use that unrealized equity to fund your daily operations or pay your employees.
It's an incredibly important distinction when evaluating GAAP accounting in the energy sector. Let's break down the mechanics of those risk management contracts.
Yeah, let's do that.
Keyera, like any responsible midstream company, they use hedges to protect their future cash flows against the extreme volatility of commodity prices. So they enter into forward contracts to lock in prices for the products they will sell in the future.
So they are basically buying insurance against price crashes.
Essentially, yes.
Yeah.
But GAAP accounting rules mandate something called mark-to-market accounting.
Right.
At the end of every quarter, Keyera has to look at the current market price of those commodities and adjust the value of their hedges on their balance sheet accordingly.
Okay.
If broader commodity prices move in a way that makes Keyera's hedges theoretically more valuable today than when they sign them, they are required to record that increase in value as a gain on their income statement.
Even though the contracts haven't settled and no actual cash has changed hands.
None whatsoever. It is a purely paper profit.
Wow.
Yeah, it inflates the GAAP earnings per share, which is exactly why that $1.19 figure flashed across every trading terminal and, triggered a buy response from retail algorithms. But it does not represent $255 million of actual cash flowing into Keyera's bank accounts during Q2.
So if you strip away that $255 million paper gain, the operating reality looks vastly different.
Very different.
I mean, it's still a solid quarter because of the KAPS toll revenue, but it completely demystifies why the EPS beat was mathematically out of proportion to a quarter that actually missed its revenue targets.
Exactly. When you remove the accounting noise, you see a company relying heavily on inorganic growth, those major acquisitions to drive the current financials.
Yeah.
And when inorganic growth is driving the bus, institutional investors immediately pivot their focus to execution.
Right, like how well they can actually run what they bought.
Precisely. How is management handling the integration of these newly purchased assets, and how are they executing their organic capital projects?
Well, let's look at project execution, because the numbers here are frankly surprising. Management reported that the KFS Frac 2 project entered service in early June.
Yeah.
That is more than a month early, and it came in 20% or $17 million under its original $85 million budget.
That's impressive.
Furthermore, there are other major capital projects like KFS North, KFS Frac 3, Capstone 4, and the ECE rail terminal are all strictly tracking on time and on budget.
Yeah, they are.
But stop right there. I have to play skeptic again.
Go for it.
Coming in 20% under budget and a full month early on, a major industrial facility. I mean, in today's macroeconomic environment where supply chains are still fractured and skilled labor is at a premium, finishing heavy infrastructure early and cheap is virtually unheard of.
It really is.
It's like finishing a home kitchen renovation early and cheap. It just doesn't happen. How do they actually achieve this?
It is rare, and it points to a level of project management maturity that really separates top-tier midstream operators from the rest of the pack.
Okay, so it's not a fluke.
No. Think of building a fractionation facility like an air traffic controller trying to land dozens of heavy planes in a storm.
Wow, okay.
You have steel procurement, specialized labor scheduling, regulatory sign-offs, and heavy equipment logistics all converging at once.
Yeah, that sounds like a nightmare.
It is. In the energy infrastructure space, capital expenditure blowouts are the historical norm. A delayed valve shipment can halt a project for weeks, burning thousands of dollars a day in idle labor costs.
So bringing KFS Frac 2 in $17 million under budget isn't just luck.
Not at all. It requires locking in fixed-price contracts for materials well in advance, having contingency supply chains, and executing flawless on-site labor management.
Right?
It signals to the market that Keyera has incredibly tight control over their procurement, and they are applying that exact same operational discipline to their acquisition integration.
Ah, right. You're talking about the Plains Canadian NGL business integration.
Exactly.
Because management reported that upon closing the Plains deal, they immediately realized $90 million of synergies, and they are targeting $120 million to $140 million run rate in the first 12 months following the close.
Yeah, the numbers are huge.
Let's get specific here, though. Synergies is a corporate buzzword that honestly usually translates to cutting redundant middle management jobs.
Sure, yeah.
So how do you find $90 million of synergies on day one in a physical pipeline business?
Well, in midstream energy, synergies are highly physical and immediate. When Keyera and Plains operated separately, they likely had overlapping infrastructure.
Okay.
They might have even been charging each other tolls to move product across adjacent systems.
Well, that makes sense.
The moment the ink dries and those systems combine, those internal tolls vanish.
Right. Instant savings.
Exactly. Furthermore, Keyera can instantly optimize pipeline routing. Instead of running two parallel pipes at 60% capacity, they can consolidate the flow into one pipe at 100% capacity, which significantly reduces the pressure and maintenance costs on the network.
Oh, wow.
They can also blend different NGL volumes across the combined network to achieve higher margin product specs.
That level of immediate optimization really explains why management is projecting so much confidence. I mean, they bumped up their 2026 growth capital expenditures to a range of $650 million to $725 million.
Yeah, specifically to cover the construction costs for the KAPS Zone 4 expansion.
Right. But here's the data point that caught everyone's attention.
The dividend.
The dividend. They increased the quarterly dividend by 4.17% to roughly 56 cents per share.
Yeah, management is painting a picture of total operational control.
Right.
They are hitting their construction targets, they are integrating massive assets flawlessly to generate cash, and they are signaling extreme confidence in future cash flows by raising the dividend.
Which makes the market's reaction on August 7th even more jarring.
It does.
I mean, if you have record margins, early project completions, massive synergies, and a dividend hike, why did institutional investors abruptly dump the stock, sending it down nearly 3% the day after earnings?
Because institutional investors read the balance sheet, not just the income statement.
Okay.
When they scrubbed the Q2 numbers, they saw a massive leverage hangover from all of this inorganic growth. At the end of the quarter, Keyera's net debt to adjusted EBITDA ratio hit 3.3 times.
Net debt at 3.3 times EBITDA. Let's put that in context for you listening. Management's own stated long-term target range for leverage is 2.5 to 3.0 times.
Exactly.
So they are sitting noticeably above their own comfort zone.
And that debt load changes the entire narrative around the dividend hike.
Help me understand the logic here, because my instinct says if you are sitting at 3.3 times leverage in a high-rate environment, you take every spare dollar of free cash flow and you aggressively pay down that debt until you're back inside your target range of 2.5 to 3.0.
That would be the conservative approach, yes.
So why are they allocating capital to raise the dividend by 4.17% instead? Is management just dangling a shiny object to distract retail investors from a bloated post-acquisition balance sheet?
Well, it is the classic corporate capital allocation tension, right? Management's defense of the dividend hike relies on the nature of the assets they just bought.
Okay.
The KAPS pipeline and the Plains assets operate on long-term fee-based contracts. Keyera doesn't have to guess what their revenue will be next year.
They already know it.
Right. They have high multi-year visibility into those cash flows, regardless of daily commodity price swings.
Okay, I see.
Because of that revenue certainty, management believes the 3.3 times debt load is easily serviceable, and they have modeled a glide path to organically deleverage back into their target range by 2028 without sacrificing shareholder returns today.
But the institutions hitting the sell button clearly didn't agree with that timeline.
No, they didn't. They looked at a macroeconomic environment that is flashing warning signs. We are seeing a broader macroeconomic rotation away from energy infrastructure.
Right.
When you combine commodity price volatility with general economic cooling, carrying excess debt above your stated target is heavily penalized by the market, regardless of how ironclad your contracts are.
Because execution risk doesn't disappear on day one.
Precisely. Immediate synergies of $90 million are fantastic, but maintaining a $140 million run rate while servicing a heavy debt load requires flawless ongoing execution for years.
Yeah, that makes sense.
Keyera is transforming into a much larger, more dominant player in the Canadian midstream space. They secured the KAPS pipeline and the Plains assets, which are undeniably Tier 1 toll roads.
For sure.
But they paid a premium to do it, and they put a massive chunk of that premium on the corporate credit card.
So if you are evaluating Keyera based on this Q2 report, here is the verdict you need to digest.
Yeah, let's summarize it.
This is a story of massive inorganic growth, masking a top-line revenue miss and temporary physical hiccups. Specifically, that 5-month AEF outage that crippled iso-octane sales.
Right.
Keyera has assembled a highly lucrative asset footprint, securing full ownership of KAPS to capture those Montney and Duvernay volumes, and they are executing their capital projects with rare precision.
They really are.
But that operational excellence is heavily weighed down by a balance sheet stretched to 3.3 times leverage, which is what fundamentally spooked the institutional market.
Exactly. And remember, the $1.19 EPS headline was mathematically distorted by a $255 million non-cash paper gain on risk management contracts.
Yeah, that paper profit.
Once you clear away that accounting noise, the tension for anyone holding this stock is entirely between their genuine operational discipline and that elevated debt ratio.
Absolutely. Now, if you rely on this kind of deep dive to manage your portfolio, make sure you follow the show. We are here delivering daily no-nonsense earnings coverage to help you cut through the accounting noise and understand the actual mechanics of the market.
And as you process Keyera's quarter, here is a final dynamic for you to model out. Management is aggressively targeting a 16 to 18% EBITDA compound annual growth rate through 2027.
Right, which is ambitious.
It is. They are basing this heavily on the toll revenues from newly acquired fee-based assets like KAPS. But those tolls rely on constant volume flowing out of the Montney and Duvernay regions.
Okay, so where's the risk?
Well, if upstream energy producers in those specific basins decide to throttle back their drilling and production volumes due to a broader economic cooling, are Keyera's long-term fee-based contracts actually ironclad enough to protect a balance sheet that is already sitting outside its leverage limits?
It is the ultimate test of their capital allocation strategy. I mean, just like a retailer relying on high-margin luxury goods, the financial engineering works brilliantly right up until the foot traffic stops entirely.